All right, my people, let's get this started. Market has opened. Market has opened, and we are not going to focus so much on the markets today and what's happening there. We are going to focus on the bootcamp. It's day 2, and day 2 is risk management. So risk management is something that I really want to highlight. It's very important. This is what can make or break you as a profitable trader. This is what can determine if you become if you are a profitable trader or not, or if you are going to become a profitable trader or not. So risk management, how to manage your risk. This is definitely one of the first thing and most important things you should learn as in your journey as becoming a trader. So yesterday, what we went through lot size, and we went through pips, we went through what broker is, and so on. And before we start today's lesson, I want to I want to recap on what we talked about yesterday. So let's do that. Let's recap on lot size and pips. What is pips? Pips is points in percentage. It's how much the market moves, the steps the market takes on the vertical price scale that you see here. And lot size, your lots is, that's how much you bet into each and every movement, into each and every pip the market moves, into each and every step the market takes. And how do you count pips? Well, most often it's the fourth digit. It's the fourth digit on the scale. Or you count it even easier. It's the fifth digit totally. So in this case, we have GBP USD. And on GBP USD, one lot. So let's say, okay, so the price now is about 121.44. 1.2144. So one lot in this case would be, if the price is 121.44, your one lot is not the one, not the two after the comma, not the one after the comma, not the four after the comma, but the fifth digit. This one. This would be the pip. This would be one pip in this case. So if the market moves from 1.2144 to 1.2145, it has moved up one pip. If it moves down to 43, sorry, it has moved down one pip. All right. So this will represent one pip in this case. To bring another example, let's look at Euro USD. Same thing. Let's look at Euro USD. Let's remove some of these drawings. What is one pip? Let's say the price right now is 1.0737. Okay, so where is the pip? One pip is the what? The fifth digit. So it's not the 1, not the 0, not the 7, not the 3, but the 7 here. So if it moves from 1.0737 to 1.0738, it has moved up one pip. That is one pip. So now when you understand what pips is, then you understand how your profit increases and decreases when you're trading, because lots is how much you bet into each and every pip. So the smallest lot you can use, let's see if I still have my drawings from yesterday, my notes from yesterday that I did with you guys. Yes, I have it. All right, so the smallest pip, the smallest lot size is 0.01. It's called a micro lot. And a micro lot is 10 cents per pip. So for every pip the market moves, you make or you lose one pip. 10 cents. The next lot size is 0.1. That's $1 per pip. So for every pip the market gains or loses, you win or lose $1. Now, then we have a standard lot, which is 1. And one lot size 1 is $10 per pip. So when the market gains 1 pip, you make $10. When the market loses 1 pip, you lose $10, depending on if it's a buy or sell. All right. Now when we have repeated that, and now when we understand that, and please, if somebody doesn't understand it, let me know in the chat box, and I will repeat it for you. Why I say that also is because it's so important that you guys understand this. You cannot trade, doesn't matter if it's signals, if you're trading with an EA or whatever it is, if you don't understand risk management. And to understand risk management, you need to understand what pips are, you need to understand what lot sizes is. So you understand how much you're risking to each and every trade you're making, okay? Now, when we understand this and we got this out of the way, let's jump into risk management. Now, risk management, what is that? It's very simple. It's how much you are willing to risk into each and every trade. So how much should you be willing to risk to each and every trade? Well, the standard that I recommend is 1 to 3%. You don't want to risk more than 1 to 3% in each and every trade. And as a beginner, I would say as a beginner with a live account, start with risking 1% per trade. So what is 1% per trade? Let's say you have a $100 account. 100 USD account. 1% out of 100 USD is of course $1, right? So that means in each and every trade, you don't want to risk more in your stop loss than $1 when you're trading a $100 account. How do you calculate that? How do you understand if you're risking $1, if you're risking more than that? Yo guys, sorry, I'm back again. My streaming software cut off. It does so sometimes. I have to check into that. So we're talking about risk management, all right? And as a newbie into this game, maybe it's your first live trading account with your first real live money trading, then you don't want to risk more than 1% per trade. If you're more risk averse, let's say 3%. So it's 1 to 3% per every trade you are taking. Now, how do you know if you're risking? How do you know how much you are risking per trade? Simple. I will show you guys. So this is why we need. It was so important for you to understand what lot size and pips are. All right. So let's say you are trading with lot size. So if you have $100 US account, you're trading with a lot size that is 0.01. Now a lot size 0.01. What is that? That's a micro lot. We already spoke about that. Micro lot. So, and that is 10 cent per pip. So it means if you're trading with a lot size 0.01, you gain or you lose 10 cent per every pip the market moves. So if I call it a trade, let's make a very easy example. Let's do like this. Let's jump into USD JPY, and now let's go to Euro USD. Let's clear our drawings so you guys see what I'm talking about. Let's go to a smaller time frame, even smaller. Okay, now let's say that we are going for a buy here. It actually looks like it's a sell coming up here, but let's say we're going in for a buy here, okay? And we are putting a stop loss that is, let's say we're putting the stop loss here. That's like a normal place to put the stop loss, and that's like 30 pips down. How I know that? I look at the number here. You see this number here? So I know that this stop loss is 30 pips down. Take profit. It can be whatever. It doesn't matter in this case because we're looking at the risk. And the risk is your stop loss. It's how much you're willing to risk per trade. Risk management is how much you're willing to risk per trade. So you have a stop loss of 30 pips. Now you are trading with a lot size 0.01. Lot size 0.01. What does that make? We're trading 10 cent per pip. That means if we have a stop loss, if our stop loss is 30 pips, Then how much are we risking on this trade? If our stop loss is 30 pips and we are risking 10 cents per pip, how much are we risking on this trade? We are risking $3, right? So we risk $3 on this trade. Now, how much is that? If you have a $100 US account, $100 account that you're trading, how much is that from your account? That is 3% from your account. So that would make, so just to put it very simple, if you have a $100 US account, USD account, and you want to know what 3% from that is, you divide it in 3. No, sorry, you don't divide it. You what if I can say that in English? You multiply it with 0.03. Sorry, my English be off sometimes in the morning. I don't know, need more coffee. So you multiply your $100 US account with 0.03. That is 3%. And what you get from that is 3, which means that your the risk that you want to take in this trade is maximum $3. So if you're trading with a lot size 0.01 and you have a 30 pip stop loss, that will be $3. All right. So if somebody doesn't understand this, please let me know in the chat box so I can explain it again, because it's very important that you guys understand this. Recap. You're trading $100 US account. You have lot size. You use lot size 0.01, which is 10 cents per pip. You are looking at a trade with a 30 pip stop loss. 30 pips times 10 cents are $3. What does that mean? That means that you are risking $3 per trade. So in this case, you are on the maximum level of risk that you want to take. But you're still within the range of 1 to 3% risk. Like that. Like that. And that is, ladies and gentlemen, very short, and like that describes very short what risk management is. Risk management is how risk aware you are. To understand risk management, to understand your risks in your trade, you have to understand your risk you're taking in each and every trade. That is very important. So risk management is how risk aware you are. You have to understand how much risk you are taking in each and every trade you are taking. And to understand that, you have to understand what lot size is, what pips is. Lot size is how much you are betting into each and every pip, into each and every step the market moves. And pips is exactly that, is how much the market moves. And you count that in pips. And when you are placing your trade, you always want to have a stop loss. And that stop loss, in that stop loss, you will see how many, you have to count how many pips your stop loss is. So in this example, we saw that the stop loss is 30 pips. If the stop loss is 30 pips and you are trading $100 US account, you want to use the minimum lot size, which is the micro lot size 0.01, and that makes 3. So that means you are betting 10 cents into each and every pip the market moves. If you have a 30 pip stop loss, that means you're betting $3. You're risking $3 into this trade. So if the trade goes in the wrong direction and you lose, you have lost $3. If it wins, well, that depends on how high up your take profit is. But let's say it's here somewhere. So let's say it's at 70 pips. So that means you are risking $3 to win $7. All right, that's the risk to reward. So you are in this trade risking $3 to win $7. Or if you want to count in the pips, you're risking 30 pips to gain 70 pips. That gives you a 2.35 risk to reward ratio. Now, with that out of the way, I think most of you understand this by now. I don't know how to repeat it more clearer. We jump into the markets and see what's going on inside the markets today. Let's see if we can catch a trade. Let's see if we can catch some actions in these markets. So the first thing we start to look at is Dixie. Dixie is the dollar cost, the dollar index, and basically showing the dollar strength against a certain baskets of currencies, which is the Japanese yen, the Swiss francs, Swedish krona, British sterling, and so on. I think it's 5 different currencies in that basket. All right, so after this whole uptrend that we've been experiencing for the last year, I would say we saw the US dollar pivot in September into October, and just made a severe dip and started to move downwards. And we've been in this channel for a while that we broke out from in beginning of February. We broke out of this channel, and right now where we're in is we are in this liquidity zone. That's the damn guys, my streaming service be bugging. I need to check this up. Because we can't be doing that. All right, so right now what the Dixie does is the Dixie is retesting this white line. You see this white line? That's a major support and resistance. And you see we broke down. We were testing it as support here, and we broke down and are retesting it from bottom now as resistance. And for y'all that are not very aware of what support and resistance is, that is what we're going to cover. I think it is tomorrow. So we will cover what is support, what is resistance, and we will cover trends as well. So if you are not 100% on what I'm talking about now, stick with me in these live streams, and if you cannot because you're working or something, watch the recordings and you will learn that, because I'm covering all the basics at this bootcamp. So again, support broke through, retesting as resistance, and now what's happening is we're just watching to see if it's going to break through this resistance to make a move up, or if we're going down. What would make this resistance break? What will make the US dollar stop moving upwards? Well, I would say first and foremost, Fed announcements, news. And for what kind of news will make the US dollar pump? Well, hawkish news. Like, for example, increase of interest rates, or an expectation of increasing of interest rates will make the US dollar start going up. Because when the interest rates goes up, when the feds are increasing the interest rates, what happens is foreign banks and institutions wants to invest into US dollar. They want to hold their liquidity or their capital as US dollars, because they get a good interest on it, and that makes the US dollar go up. So with that said, we have news today. Today's Tuesday, February the 14th. Happy Valentine's Day, by the way. And don't forget to buy some flowers or do something nice for the people that, it doesn't only have to be your girl or your boy or whatever, but for the people that you care for, you know. It can be your mom. So today we have red folders for US dollar. So it means today we can see some major action on the Dixie, and we can see some major action in gold, indexes, even crypto, Bitcoin, and a lot of other, like most currencies that are paired against US dollars. We can see a lot of action today. So today, be aware of that. If you don't have forexfactory.com, get it so that you can be on top of the news that are. And let's just take a quick look into what these folders are saying today. So we have news 2:30 p.m. today. US dollar is the CPI. What is CPI? CPI is the consumer price index. So this is basically inflation. How big is the inflation rate? Let's see, change in the price of goods and services purchased by consumers. So as I said, the inflation rate. And what you see here, usual effect, actual greater than forecast is good for currency. So forecast is 0.5%. 0.5% increase in the interest rate. What does that mean? So if, let's say, if the forecast is, if the report is that the inflation rate is higher than forecasted, higher than 0.5, that will make the US dollar pump. That will make US dollar go up. If the US dollar goes up, you can expect a major drop in gold, crypto, some indexes, like for example the US 30, and also in all currency pairs that are paired against the US dollar. All right. So that is 2:30 today. Remember that. I would even set an alarm. If you're trading actively, set an alarm. Back to the charts. So now when we know what to expect from the US dollar today, where we are, we look at gold. Sweet, sweet gold. Gold. All right, so looking at it quickly, let's see if I can get some room here. So looking at it quickly, what we see is we have Fibonacci pulled from this top to this bottom. Or do we really? Let's recalibrate this Fibonacci and see where we're at. Yeah, let's pull it all the way to the bottom. Like that. All right. So from this top to this bottom, we have pulled Fibonacci. And what we see is that market came up and rejected the 38.2 Fibonacci retracement. So it rejected 38.2 Fibonacci retracement, which is a classic, most often does so. But on the 4-hourly time frame, what we see is that the market rejected it just with a wick. The candle hasn't closed yet. So we still have 1 hour and 30 minutes on this candle before it closes. What we're more rejecting is this gray zone. This gray zone is a liquidity zone. It's a zone with a lot of market orders. So to understand if we're going to continue up or continue down, we first have to narrow this down a little bit. And what we then quickly see is that we are ranging right now. So what I mean with that is we're basically stuck in this zone here. And we're ranging in that zone. All right. So it's very possible that you will see the market, if you look at this as a top and this as a bottom of this ranging zone. So we are looking for the market now basically to break out either underneath or above. And what will decide that is straight up the US dollar, the Dixie. So you want to keep your eyes on the Dixie to understand if the market is going to break up or break down. for gold and for currency pairs paired against the US dollar. And to know if what the Dixie is going to do today, keep an eye on the news. So news are very, very important today. Very important today. We will. So in other words, for gold, I don't see much right now. The only thing I see straight up is this. We have support here, and the market is testing it right now as we speak. So the market is testing this support. We might break through, but if we break through for a sell, it's no big movements we are looking for. All right, it's basically a sell from here to these lows here, because we don't know if the market is going to go underneath, continue down there, or reverse and move up. So this move would make about, let's see how many pips this moves is. This is a 50 pip move, so 50 pips ain't bad. The problem is the risk to reward ratio. If you put a trade with a 50 pip, with 50 pips inside gold, gold is very volatile. It moves very quick, and you always want to have like at least a 30 pip stop loss when trading gold, because it can easily just go reverse, stop you out, which is most often does, and then go in your direction. So you want to have at least a 30 pip stop loss, and you want to adjust your risk management that we spoke about earlier accordingly, so that your if you have that 30 pip stop loss, and if you have a $100 US account you're trading with a micro lot 0.01, which means you're risking $3 per trade. That's why I'm always saying also that you don't want to trade gold if you have a $100 US account. Like, you want to have at least, I would say at least a $400 or $500 US account to trade gold. Why? Because it's volatile. So in other words, this little scalp that we were looking at is exactly what I just said. It's a scalp, and a scalp is nothing that I can call out on this live trades. Why? Is because the delay from when I'm talking to when you're hearing it, it's about 5, 6, 7 seconds. During those 5, 6, 7 seconds, a lot can happen, especially in scalping, because when you're scalping you're trading with a higher lot size, shorter stop losses, also shorter take profits. You just want to scalp a couple of pips in the markets, quick, easy, and what you're doing is you're scalping the momentum in the market. You see where the volume is coming into the market, and you use that momentum of volume coming in to scalp the market for short. Okay, we're back again. Let's just do like this. So now you understand now you even got a short lecture on what scalping is and why we ain't scalping the gold market. So what we can look at instead is we got major US dollar news coming out today. So what is interesting for us is currency pairs paired against US dollar. So Euro USD is of course a very interesting pair to trade, and we've been looking at Euro USD a lot. We're gonna do that now as well, but before we do that, we want to see if Manara got something to say on the Euro US dollar. Has Manara spotted something interesting for us? Incomplete. Let's see. I'm just sidetracking a little bit. I want to see what it says about gold, but it's nothing new from what I see here. No, this is interesting. All right. A lot of gold. Very interesting. All right, let's move down. Let's see if we get some euro US dollar. Yep, here it is, euro USD. Let's see if we got something that is finished. Head and shoulders already gone. Godly already gone. Head and shoulders already gone. I think it's already gone. This one is incomplete, but very interesting though. Okay, so from what I see now, this is the most interesting one. Yeah. 10723. Let's look at this. Naira gives us an entry at about 10723. It's about there. And that was the Gartley pattern. We have the Gartley pattern here as well, also incomplete. 10723, same thing. Okay, so we're looking at the euro US dollar. Monero has given us an entry at about 10723, 1.0723 to be more precise, which is here. That's the entry that Monero has called out for us. Now let's see if we can find some confirmations in for us to be willing to take this trade. This trade, for us to take it, it will be a buy limit if the market doesn't come down here before I finish this trade. So that means the market is not at the buy place yet, not at the execution place yet. We want the market to come to us, like I've said many times before. Find places, find spots in the market where you can see the market coming towards, and position yourself there. We go to the daily time frame just to check what's up on the bigger time on the bigger scale. What I'm doing now is I'm pulling out Fibonacci. I want to find some levels in the market. Okay, interesting. Interesting. Yeah. All right. So what we have is this. After this big rundown, which correlates perfectly with the Dixie, that had this big run up. And remember what I said? Currency pairs that are paired against US dollar will move in reverse to the US dollar. So when the US dollar goes up, that currency pair goes down. And that is what has happened here. We had a major downtrend for several months, basically a year. And now we are moving back up again as the US dollar is moving back down again. All right, US dollar down, Euro USD up. Okay. In this move down, what has happened is, so we have this big swing here with this top and this bottom. We have pulled Fibonacci here to find some levels, and the levels that we directly see, we're always looking out for the 38.2 retracement. That's where we always will find resistance on in the retrace, and we're always looking for the sweet spot. That's the first two levels and zones we're always looking for. The sweet spot is the 50% to the 61.8% retracement. So these two yellow lines is the sweet spot zone. Why is it called the sweet spot zone? Is because that's where you most often will find a lot of unfilled orders in the market. If you don't know what market volume is and orders, stick with me on this channel. I will explain it. Not today, because today we were covering risk management, but I will cover it probably next week, I would say. So I haven't made a plan yet for what I'm covering next week in the on the educational side of the streams, but I will probably cover volume and market orders, liquidity zones, because it's very important to understand where those are, to understand where the market is pulling towards. So back to it. This is the sweet spot zone. Is it? That's a zone that the market wants to pull towards. It came up here, picked up liquidity, and dropped down a little bit. What does that mean? Well, it doesn't mean much. I would love to see the market come down and retest this 38.2 Fibonacci retracement. So retest it as support, confirm it as support to see the market move to proceed upwards. But today, to know what the market is going to do today, we have to keep our eyes on the news. So what did we say? Today we have news. Today we have major news. We have red folders for the US dollars. For the US dollar is the CPI, the Consumer Price Index numbers will be released today, and we will see if it's better than forecasted, the US dollar will pump. If it's less than forecasted, the US dollar will drop. If the US dollar pumps, the Euro USD will drop. If and the same thing with gold. Gold will also drop. Probably crypto will also drop. So if the US dollar drops, Euro USD will pump, gold will pump, cryptos will pump, US 30 will pump. Basically everything that is paired against the US dollar will pump. So now when we understand that, let's go on a lower time frame. Let's go on the 4-hourly time frame and see if we can get some levels here to see what we might expect, or to see to what levels we can expect the US dollar to move towards. From this major drop that we had since last week, no, since 2 weeks ago actually. So this whole drop we had, we saw market come down. Let me just check one thing quick. Yeah. So we saw market come down, move back up to test the 23.6 Fibonacci retracement. So we're testing the 26.3 Fibonacci retracement right now as resistance. So the question is, will it hold as resistance? Well, that's again up to the US dollar and what it does today according to the news. But we're going down on a lower time frame to see if we can spot a trade here. So we're down on an hourly time frame now, and what we then see is that from this swing down, so from this top to this bottom, market has moved up into the sweet spot zone and is testing the upper level of the sweet spot zone, which is the 61.8 retracement. Let me do like this. This will make everything easier visually, so you don't confuse the different Fibonacci lines. I know it can get messy sometimes, but we're trying to keep it as simple as possible. Alright, so from this top to this bottom, we pull Fibonacci, and what do we see? We see that the market has come into the sweet spot zone. The 50% to the 61.8% Fibonacci retracement. That's the yellow zone. And Manara is giving us a trade at 1.0723. Oh. And that is at the bottom of this 50% Fibonacci, at the bottom of the sweet spot zone. So that is the 50% Fibonacci retracement. Now I like that. That correlates nice. We like that, and it gives us a buy. It gives us a signal of a buy. So let's see if we can get some more confirmations on that. Can we get a buy here? Can we put a buy order here? Is this a good place to put a buy order? Oop. I will do this. So we have the sweet spot zone. Let's pull a box there to mark it out. This is the sweet spot. Do like this. All right, so I have the sweet spot marked out. And we want to mark out another thing. We want to mark out the supply zone. This is where we have a lot of supply in the market. Between the 78.6 to the 88.6 Fibonacci retracement is where you will find a lot of supply. So now we can remove this Fibonacci to clear this chart a little bit. And now we know this is sweet spot zone. This is the supply zone. If the market goes up, I would definitely put my stop loss, take profit either at the bottom of the supply zone or at the top of the supply zone. But we want more confirmations first to see if we jumping into this market or not. So let's look at volume profile. This is volume profile. What volume profile does is it shows you volume in what's visible on the screen. So for everything that's visible on the screen, it will show you volume, where the most of the volume is, and the highlighted part of the volume is where 70% of the volume is. So we want to see. We don't need to see the big picture in this case because we're looking for entries. So we just want to see the volume for this whole swing. Where's the most of this volume? The most of this volume is at the zone where we're at right now. So you guys can see that we're stuck at the place where we have a lot of volume. And you guys see it correlates perfectly with the sweet spot zone. So the yellow highlighted zone. Let me make it a little bit clearer for you. Maybe it's not so visible. So you see the volume correlates perfectly with the sweet spot zone. And this is as I said before, the sweet spot zone is the zone where you find a lot of volume. The market is inside it, so it needs to break out of this zone before we can see any clear directions in the market. So Manara has called out a trade that is at the bottom of the zone, at the 50% Fibonacci retracement of this swing, from this top to this bottom. We want to see if we can find some more confirmations on that. First off, volume doesn't give us any confirmation to if the market will move upwards or downwards. The only thing we can see here is that we have the sweet spot from this bigger swing, from this top to this bottom. We have the sweet spot zone right here, and we have a lot of liquidity here. So when you have massive dropping candles like this, or massive candles like this, that's when you will know there's a lot of liquidity stuck there. So I can definitely imagine that the market will pull up towards the sweet spot zone of this bigger swing, of this whole swing. And that would place us into a buy, into a potential buy to this zone, right? Now, let's see if what EMA shows us. So EMA on the hourly time frame shows us this, that we are having support from the 20-day EMA, which is the yellow line, the 20-day EMA, and then we have the 200-day EMA. That's the red line you see here, and that is a potential resistance that we will face if the market goes in for a buy. So if we're going in for buy, I would definitely put my first stop loss, my first take profit just beneath where we expect the 200-day EMA to be. With that said, it's looking more and more like a buy here. Yeah. Looking at the 4-hourly time frame, what do we see? We see that the market rejected the 200-day EMA. And it's coming back down to test the 20-day EMA, which will correlate perfectly with the 50% Fibonacci retracement. So it will correlate perfectly with the bottom of the sweet spot zone that I spoke about before. Now, let's go to the 50-minute time frame to see if we can see a spot an entry for this trade. So, another correlation that shows that we have good support at this zone here, at the bottom of the sweet spot zone, is that you see the volume. When I'm pulling volume from this, from when this swing started, yeah, it's about there. When I pull that volume up, yeah, you see the top section of that volume is perfectly correlated at the bottom of the sweet spot zone. So it means we face it, and the top of a volume zone most often acts as support or resistance. So we have more support here. Market comes down here to the entry zone. This is the entry zone. We'll probably see the 200-day EMA on the 50-minute time frame also correlate perfectly as support. So I would say I definitely see a very good entry at the same place where Manara calls it out. This is where Manara is calling it out. So you see the market's pumping up now, right? But that doesn't matter so much. It can come down at any moment because the Gartner pattern that we see here is not completed. So when market comes down to the entry zone, that is when it's completed. And that is when we have a trade. So in this case, we have it exactly as we wanted. We have a trade that we want the market to do certain stuff before we enter the trade. It means we want to see the market come down and test this bottom of the sweet spot zone as support before we want to enter this trade. So if the market comes down here, we are entering, or I am entering. And what you guys do, that is totally up to you. Nothing I say here is financial advice. Remember that. Merely my own opinions and merely my own trading strategies that I'm sharing with you guys. So I'm just telling you guys what I'm doing, and if you guys want to follow along, that's cool. I will call these trades out on in the Prosperous Trade Signals group, and I will call it out as a buy limit. So now that we are clear on that this is a buy limit, we want to see where are we putting the stop losses and the take profits. So the stop loss would definitely in this case be like, I'm gonna be honest with you guys, I want to put it down here. This is where I want to put the stop loss, but that's a 57 pip stop loss, so it's too much. Then we need to have look for a swing trade. We're gonna have that big of a stop loss. So let's see if we can put 22 pip stop loss at about here. All right, let's make it a 25 pip stop loss. That's here. So that's a stop loss. Let me write this down so you guys get the numbers. Euro, USD, entry 1.07235. And we spoke about pips in this before. So what is 1 pip in the Euro USD? And in this case, is the fifth number. Remember that, the fifth number. So 1, 2, 3, 4, 5. This is the pip. So if this goes up to 4, then you have gained 1 pip. If this goes down to 2, you have lost 1 pip. Remember that with your risk management. So this is the entry. And stop loss would be at 106.98, which is perfect because it's just beneath a whole number. So a whole number is in this case 1.07. This is just beneath it because market tends to bounce off whole numbers, reject whole numbers. Now we need a take profit 1. Where are we putting the take profit 1? Let's see. Take profit 1. Let's see this. So this is what I will do. You got on the 4-hourly time frame, you got this 200-day EMA that the market is rejecting. It's testing it right now and and if it's rejecting it to come down to our entry, then that's where I will put my first take profit. So in this case, and as you guys can see, it correlates perfectly with a 23.6 Fibonacci retracement from this drop. So I would put my first take profit. Yeah, we're putting it at the 23.6, just underneath the 23.6 Fibonacci retracement. So that would make it, let me get, just underneath would be 1.073074, I would say. 1.0744, like that. TP2. Where are we putting the TP2? TP2, we put it at the bottom of the supply zone. And that will be 1.076. So the 1.076, that's TP2. 0.76. And TP3, in this case, I would say first at this tops here, so just underneath the 38.2 Fibonacci retracement, which is a typical reversal zone for the markets in this case, just underneath we'll put it equally with these tops. So what I do is put TP3 at 1.078, 1.079. Like that. And TP4, we'll leave it open. But our target is definitely the supply zone, the big supply zone that we see here. And that will put us at about, a target will be 1.095. 0.095. 1.095. 0.954 even, to be more precise. No, sorry, 0.952. Just to be as precise as possible, to sniper in those entries and those take profits. So that if we get this trade all the way up here, that's a major trade. That's a trade of 230 pips. So we got a 230 pip take profit trade with a 30 pip stop loss, with a 25 pip stop loss. Now for that to happen, the market needs to come back down here and execute our buy limit. So this is a buy limit trade. Okay, good. This is it, guys. This is what I'm seeing right now. I will send this one out in the prosperous signals. So if you're in the signals channel, I'm sending this one out now. If you ain't in it, you'll find a link in the description box, in the description for this stream. That's that. This is the signals channel. I'm just letting you see what I'm doing, so you're not wondering why I'm quiet. Let's go back to this. Let's see, reply. So this trade is inside the prosperous signals channel, and if you ain't in it already, then you want to join it ASAP, so you're up to date with the trades I'm calling out, we are calling out, and setups, tips, information. With that said, we're done with the stream today. Remember, CPI numbers coming out today, very important, will affect the market severely. You can expect a lot of volatility, especially for currency pairs paired against the US dollar. So you will see the US dollar move a lot. You will see gold move a lot. You will see Euro USD move a lot, for example, and so on. So be aware of that. And with that said, trade safe, stay blessed, and be prosperous. Salud.